Hi, I'm Illinois State Treasurer Michael Frericks, and thank you for joining me today for the last FinWell Fireside live stream of the season. The Illinois Financial Wellness Hub, or FinWell Hub as we like to say, provides free resources to help all Illinois residents plan a better financial future. We've dropped a link for the FinWell Hub in the chat and encourage you to sign up for an account. But before we get started, I have a few housekeeping items. Throughout the webinar, we will share helpful links in the chat. We will answer audience questions towards the end of the program, and you can submit questions using the Q&A section. Click on the three dots in the right-hand corner of the screen and select Q&A. While we answer questions at the end, you're encouraged to submit questions at any time during the program. Closed captioning is available in English. Click on the CC icon in the left-hand corner of your screen to turn on closed captioning. We are joined by a sign language interpreter. Sharon, thank you. You can change the size of her video box to meet your needs by clicking and dragging the edge of the box to expand or minimize. This is being recorded and will be available in the webinar section of the FinWell Hub soon. Now, we're ready to get started. Today, we're going to discuss Social Security and retirement to help you better understand how your benefits are calculated and to help you prepare for your future. I'm joined by our special guest, Jack Myers. Jack is a public affairs specialist with the Social Security Administration. He helps coordinate the public affairs activities of 29 Social Security offices in Illinois and Indiana. He's worked for Social Security for 23 years, and Jack is a Central Illinois native and a graduate of Illinois State University. Go Redbirds. Jack, welcome. Let's start off. Who is eligible for Social Security benefits?
Well, thank you, Treasurer. Appreciate the opportunity to share information with people about our programs. To be eligible for Social Security benefits, you have to be at least 62 years of age, and you have to have what we call insured status. So what that means is basically you've worked enough and you've paid enough into our programs to be eligible. Insured status is computed by what we call credits. So as you work and you pay Social Security taxes, you earn these credits. The amount of credits that you need is 40. You can earn up to 4 per year. So you basically have to work at least 10 years under our program to become eligible for a retirement benefit. And the amount of money that it takes to earn one credit varies a little bit from year to year.
So it's dollars, not time.
Dollars, not time, yeah. So in 2023, it's $1,640 for a credit. So that gets you one credit that's in gross wages or net earnings from self-employment. So if you earn 4 times that, you would have your full 4 credits for the year.
And if you earn 10 times that, it's still 4 credits.
Still 4 credits, yep. The 10 times that, though, is important still because that speaks to when you get your benefit amount.
Right. So this seems very complicated. You can retire at different ages. People have different incomes. They work for different periods. Some people work for employers that are exempt. So how are benefits calculated?
So that's where we get into the amount you earn. So the 40 credits gets you the basic eligibility, but in terms of calculating your monthly benefit, we're actually going to look at your entire earnings history. We're going to adjust the earlier years for inflation. We call that indexing. So essentially what we're doing is we're trying to bring all of your earlier years up to today's dollars, and then we'll select the 35 best years. So even though you only need 10 years of work that's covered by Social Security to qualify for a retirement benefit, the more years of work under the system, the better, because we're going to use the 35 best years in our calculation of your monthly benefit. So if you don't have 35 years, we'll end up having to plug some zeros in there when we get the average and apply our formula to it. So anything you can do to get at least 35 years of work under Social Security will be beneficial when it comes time to compute that monthly benefit.
Okay, so I worked in the summers, detasseling, working in the fields when I was 13, 14, 15 years old. I think I paid into Social Security. So those years could count for some credits, depending how much I earned?
So they could, potentially. And what we're going to do is, we're going to look back and we're going to adjust those early years for inflation. So we're using today's dollars and comparing apples to apples. And then if they happen to be among your 35 best years, we will use those in the calculation of your benefits.
I really hope they're not among my best 35 years. I worked for minimum wage many years ago, not very long. But so let's say someone like me is curious how much I have accumulated, or maybe I'm just curious, like what was I making in 1987 or 88?
Sure.
Can someone check their earnings record?
Absolutely, and I really recommend that you do. The way you would do that is pretty easy. So you would go to our website, which is ssa.gov. Make sure you're at .gov. That's the official Social Security website.
What will we find if we go to ssa.com?
You would find a site, but it wouldn't be ours.
Good.
So,
ssa.gov.
there you go, ssa.gov. Once you're there, you want to look for what we call My Social Security, where you would create your own personal My Social Security account. And that's really a wonderful financial planning tool. It's a portal to your own personal Social Security information. You can navigate directly to it by going to ssa.gov/myaccount, or just look for it on the website. Once you've created that account, you can look at your earnings history. You can verify the accuracy of it. It's important to do that because if you spot a problem with your earnings, we can fix it for you.
Great. And so this is not for someone imminently approaching retirement. Someone in their 20s or their 30s could also check to make sure there wasn't a mistake, an employer didn't made all the payments.
Absolutely. You know, I would encourage people who are younger to do that, because if you spot a problem, it's pretty easy for us at Social Security to fix that. What you would need to do is show us your W-2, or if you were self-employed, show us your tax return and your proof of tax paid, and we can get that corrected very easily for you. The problem would come into play if it was 20, 30 years down the road and you no longer have those documents. So finding out about that early while you still have the documents is much preferred to finding out later when you might not have them.
Good. So checking early is good and helpful. What is the full retirement age? Because I hear lots of different things. I think it depends on what year you're born, and then, what is full retirement age?
Yeah, so full retirement age is going to be the year at which you could get 100% of your benefit, and that's going to be 67 if you were born 1960 or later. It used to be 65, so you could potentially have somebody whose full retirement age was 65. For anybody born 1938 or later, that full retirement age is 67, or 1960 or later rather, that full retirement age is 67. But when they changed it from 65 to 67, it was a pretty slow, gradual change.
Yes, I thought because it went 65 to 66 and it stopped at 67.
Yeah, so basically, if you were born 1938 or later, you had, like in 38 it was 65 in 2 months, in 39 it was 65 in 4 months. So for anybody born 1943 to 54, it was 66. If you were born 55 through 59, it's somewhere between 66 and 67. And then if you're born 1960 or later, the full retirement age is 67.
I knew that there were steps because I had this conversation with my father, who was born in 44, but I wasn't aware there were so many of them.
Yes, yeah. So sometimes people think that the full retirement age keeps changing, but it actually doesn't, because it was changed from 65 and then gradually to 67. But there are a lot of, as you said, steps in the middle there.
Okay, so that's the full retirement age, but some people say, I want to start drawing money as soon as possible. So when can someone start drawing Social Security benefits if they want to start soon? And how does their age affect the benefits they receive? I think that sometimes we have delayed gratification. People want it quickly, but there are consequences to drawing early.
There are. So, really what I tell people and what we tell people at Social Security is that the choice of when to begin collecting your benefits is a personal decision you have to make. And your opportunity starts at age 62. So you could collect a benefit from Social Security beginning at 62.
And that 62 is the same whether you're born in 1938 or 1978.
That's correct. That's correct. So where the change comes in is if your full retirement age is 66 or it's 67, if you elect to take your benefits at 62, the reduction for taking the benefits early is going to be greater, because the way we compute that reduction is we calculate how many months you are away from your full retirement age. And so if you have a later full retirement age and you take benefits at 62, you're going to be further away, therefore a greater reduction. So, really, you have to kind of weigh out, do you want to take it early? Do you want to wait until the full retirement age and take it, unreduced at 100%? Or you could even wait until age 70 and you would really maximize your benefit through what we call delayed retirement credits that accrue from full retirement age up to age 70.
Okay, so now you throw another curveball here. I find this fascinating. One of the great things about being state treasurer is I've not given a lot of thought to Social Security, but I get to have nice conversations like this, and hopefully other people are benefiting. Those delayed benefits, if I say, I'm still working, I still have a job that I love, I don't need the money today, and I decide to push off to 70, how would that affect my benefits?
So that would increase your benefit. Basically, if you think about it from 62 to 70, from 62 up until full retirement age, you're looking at a reduction in your benefit. At your full retirement age, you're going to get the full 100% benefit. And if you defer sometime beyond full retirement age, say up until age 70, you're going to get an increase from full retirement age up to age 70 of 8% per year. So if your full retirement age is 67 and you choose to wait until 70, you could actually increase your benefit amount by 24% by waiting until age 70. There wouldn't be any advantage to waiting beyond 70 because the delayed retirement credits stop accruing at 70.
Okay, now I think everyone has to make their own decisions, and I know Social Security Administration doesn't like to say there's a break-even point, but for what kind of people would it make sense to delay their benefits another 3 years?
So, I guess it kind of runs the gamut. One of the things that we tell people is, of course, it is a personal decision, but there are factors that you have to look at. One of the factors to look at is your health.
Yeah.
When you're approaching retirement age, you have to look at how healthy are you? What is your family history longevity-wise? Is it a relatively good bet that you're going to live to be in your 90s? And in that case, it may behoove you to wait and have a higher benefit amount. That might be in your best interest. If unfortunately you're not in that situation and your health isn't the best, then it might make more sense to draw early. Another thing to consider is, will you have a surviving spouse who's going to be drawing off of you? Because their benefit as a survivor could be impacted by your choice of when you begin to collect your benefits.
Well, that is a great question. I got remarried last year, and so spousal benefits are something I would be considering right now. I know there are several variables that impact eligibility, so why don't we discuss some common scenarios for spousal benefits?
Sure. So with spousal benefits, you have to consider the situation more than anything because of those variables. Let's say, for example, you have a situation where one member of the couple works and one member of the couple stays home and doesn't work, doesn't pay into Social Security, doesn't work outside the home. In that scenario, the working spouse, when they decide to draw their retirement benefits from Social Security, that would trigger eligibility for the non-working spouse. Now, we would have to look at things like the age of the non-working spouse. That non-working spouse would have to be old enough or have a young child in care or a disabled child. But if we're kind of focusing on retirement, we'll think more on the lines of age. So that non-working spouse would have to be 62 or older, and then they would be eligible for up to half of the benefit of the working spouse. So there is a spousal benefit that would be payable to that non-working spouse, and it's all controlled by when the working spouse starts to collect.
Even if they're younger than 62, if there were a 90-year-old billionaire who married a 20-year-old? I think there have been stories like that, and then passed away. Could someone in their 20s start receiving benefits if they were a spouse?
So what we would be looking at there, if we're talking spousal benefits, generally we use spousal benefits to refer to when both people are still alive, and we use widowers.
Okay.
So just to be clear on terminology, if it was a spousal benefit, you could have a situation where a much younger spouse would qualify for a benefit. For that to happen, though, there would have to be a young child. The younger spouse would have to have the young child of the deceased or the working spouse in their care, and that benefit would be payable until that child turns 16, Or if that child was found to be disabled, then they could continue that benefit longer.
Okay. So a couple scenarios. Scenario one, let's say one person works outside the home and the other has not worked outside the home long enough to qualify for Social Security on their own record. Can you talk a little about what happens there?
Yeah, so in that scenario, that's where that non-working spouse would qualify for the spousal benefit. It would be, the amount would be 50%, or the gross amount would be 50% of the working spouse's benefit at their full retirement age. But it's kind of rare, actually, that the spouse actually gets the 50%. And the reason for that is it's controlled by their age. So if the spouse, the non-working spouse, chooses to collect that benefit at 62 or 63 or some point prior to their own full retirement age, it's not going to be a full 50%. It's going to be a lower percentage that's based on when they chose to take it. So, but the good news there is that there is a benefit that would be payable to them in that situation.
Okay. All right, so scenario two, let's say both people worked outside of the home. Does that rule out the possibility of spousal benefits? Is there a relationship between spousal benefits and a person's own retirement benefit?
It could potentially rule it out. So this is where we would have to look at the numbers. It would become a numbers game at this point in time.
Okay.
Because as a spouse, when both people are living, and this is kind of where it's important to clarify, we're talking about when both are still alive, in that scenario, you have to take your own benefit first. So and I use my own example, my own situation. I'm married, I work, my wife works. When we become retirement age, there's not going to be a spousal benefit payable to either of us as long as we're both still alive, because my benefit is going to be more than one half of hers. Her benefit is going to be more than one half of mine. So I will get mine, she will get hers. There's no eligibility there because our own is going to be greater than half of the other. Now, what you could see though, is you could see a situation where one spouse was a significantly higher earner than the other.
Okay.
And so in that scenario, half of their benefit might exceed the benefit
The full benefit of the
yes,
spouse.
exactly. The full benefit of the lesser earning spouse. And in that scenario, the lesser earning spouse could collect their own and then a little bit more to get them up to half of the higher earning spouse's benefit.
So you still collect yours first,
Correct.
but if you're entitled to more, you can collect more.
That's right. Yep.
Okay, so in that case, let's say both of them worked outside the home. One made significantly more and the other made less. When they reach their age where they choose to take, they each would get their benefit.
That's right.
After the higher earning spouse passes away, the surviving spouse could see an increase.
Yes,
Okay.
yes, because once you talk about a survivor benefit, there are some things that change, and that's one of them that you just mentioned. The benefit rate as a survivor is up to 100%, not 50%. So exactly how you just laid it out, that lesser earning spouse would see an increase in that scenario as a surviving spouse if the higher earning spouse passed first.
Okay, so there's when people's spouses pass, but we also have things like divorce. So let's say someone was married for 35 years, they retire, they are spending a lot more time together and decide they don't want to spend more time together, they divorce. How do divorced spouses qualify?
Yeah, so there is a possibility for a divorced spouse to draw a benefit.
Okay.
The way that works is, in order to be eligible, you have to have been married at least 10 years. So 35 years obviously would qualify there. It really just comes down to they have to have been married for 10 years, and the spouse who wants to draw off of the other one has to be unmarried. So if you're the one that was, in this equation, I guess, the lesser or non-earning spouse, and you want to draw off of your ex, you have to be unmarried. The ex-spouse that you're drawing off of can be remarried and it wouldn't have an impact. But you, who wants to receive off their record, has to be unmarried as long as they're alive. And there's a change, though, that's relatively, are very important to mention here, because while you're still married, as a spouse, you can't collect until your spouse does. But as a divorced spouse, you could potentially receive benefits even if they're not yet collecting. There's something we call an independently entitled divorced spouse. As long as you were married for at least 10 years and have been divorced for 2, and you are unmarried, if you're 62 or older and your spouse is 62 or older, you could begin collecting off of theirs.
Even if they choose to defer till age 70.
Even if they are deferring to 70.
Now, let's say I don't collect my benefits, my divorced spouse decides they want to. Does that affect my benefits at all?
Great news, it does not.
Okay.
It does not affect you at all.
Divorces can be contentious, and if it affects someone's benefits, I'm sure it'll become even more so.
That's right. And the other thing to note is, just like with a current spouse, if your ex-spouse wants to collect off of you, they still have to take their own first. Okay, so we're still going to make that same comparison between their benefit and your benefit. And if their benefit is greater than 1/2 of yours, there's nothing that we can pay them off of your record. But even if there is something we can pay, it doesn't affect you in any way.
Okay. Now, we're talking about divorce. We should also talk about other lovely subjects like death. What changes if a spouse dies?
So there are some important changes that we need to talk about with the benefits if the spouse passes away. So then we're transitioning, and we're no longer talking about what we call spousal benefits. We're getting into widows or widowers, survivor
benefits. Okay.
Yes. And so one of the biggest changes is the age of eligibility. For a surviving spouse, you can qualify for benefit as early as age 60 or 50 if disabled. So you don't have to be 62 to draw as a widow or a widower. Now, there is an earnings limitation that's involved, but if you're not working, you could qualify.
That's if the surviving spouse is disabled. If the deceased spouse was disabled, they still have to wait till at least age 60?
60, right. Okay. Yep. So age 60 is where eligibility would potentially begin for a non-disabled widow or widower, 50 for a disabled widow or widower. You would still be looking at a reduction, though. I mean, if you take it at 60, that's not your full retirement age, so you're looking at a potential reduction. But that is still on the table. That's something that you could think about. And then we kind of talked about this a little bit already in the amount. Instead of being a 50% benefit, it's up to 100% as a survivor. So that opens the door for a lot of people who didn't qualify as a spouse. They potentially could qualify as a surviving spouse, because your benefit might not have been, less than 50% of your spouse, but your benefit might be overall less. So, if one of you was likely to be the higher earner and have a higher benefit, if the one that had the higher benefit dies first, that's going to open the door for some potential survivor benefits for the survivor. So that is, we see a lot more survivor benefits than we do spousal benefits. And then the other thing to point out, the other big change, and this kind of gets down to strategy and financial planning, is that as a survivor, you do have the opportunity to start on one record and switch to the other later. So you could start your survivor benefits at age 60 and defer your own until full retirement age, or until age 70.
And then at age 70, you switch to your own benefit away from the survivor.
Exactly. And you could also do it the other way, depending on how the numbers work out. You could wait till 62, take your own if it's going to be the lesser benefit, and then switch to the switch to the survivor's benefit at your full retirement age. Something to be aware of, though, is if you're starting on your own and switching to theirs, full retirement age is the point where you would want to make the switch, because you don't get the delayed retirement credits for waiting. But if you're starting on theirs and switching to yours, you might consider deferring all the way till 70, because yours tops out at 70.
Okay. Well, I find this fascinating because I'm learning lots here. Hopefully our viewers are as well. But let's move on from spousal benefits. There are a lot of other things to talk about. What about retirement income like a pension or investment accounts such as a 401k? Will that affect my benefits?
That it's important that we do get into that, and I've talked, or at least alluded a little bit to limitations. If you want to collect a benefit from Social Security prior to your full retirement age, there are limitations on your earnings. But the good thing about retirement income, when we talk about earnings limits, retirement income is not what we're looking at. So we're not looking at 401ks, we're not looking at pensions, we're not looking at your Social Security benefits. The only thing that we're really looking at in determining whether or not you're making too much, if you will, to qualify for a retirement benefit or a spousal benefit or a surviving spousal benefit is your earned income. So retirement income is not going to affect your ability to draw Social Security benefits.
Okay. So you talked about retirement income. Can you expand on working while receiving benefits? How does that income affect benefits?
Absolutely. So, when we talk about the earnings limit, there definitely are limits. We call it the annual earnings test, where basically if you want to work and collect a Social Security benefit that's not based on disability, so we're talking retirement, spousal, surviving spousal benefits, anything that you can collect from us that's not based on disability, there is going to be potential for an earnings limit. And as we just mentioned, the limit is based on what you're earning, earned income. So gross wages if you work for somebody else, net earnings from self-employment. And what you really have to evaluate in trying to determine if you have a limit is your age. If you're full retirement age or older, there's no limit.
Oh, okay.
So you can work and earn as much as you want and still collect your Social Security benefits. If you are under full retirement age, then you're going to have to kind of ask yourself a question: will I be getting to my full retirement age within this calendar year or not? And if the answer is no, then you're going to be subject to the higher limit or the lower limit on the top part of the table that you're seeing on your screen right now, which is $21,240 per year. If you're earning more than that,
say that number again.
it's $21,240.
Okay.
That would be your gross wages or net earnings from self-employment. If you're going to earn more than that, it's not necessarily a deal breaker. The penalty is 1 for 2. So you would have to pay back $1 of Social Security for every $2 you go over. So if you're just slightly over, in some cases it makes sense for people to go ahead and start drawing, pay back a little bit or pay it up front and still get benefits the rest of the year. But if you're going to be significantly over that limit, it might make more sense for you to wait. Then we would fast forward. If you said, yes, I am going to be hitting my full retirement age this year, we would fast forward to the second limit you see on the screen, which is $56,520. And what that limit means is, that's the limit that would pertain for the months leading up to full retirement age. So if you were going to be hitting your full retirement age in August of a calendar year, of this calendar year, we'll say, because it's this year's limit, starting in August, there would be no earnings limit. But for January through July, the earnings limit would be that $56,520. So again, that's only important if you've chosen to start to collect your benefits prior to full retirement age. And it just speaks to the fact that you probably could get your benefits prior to full retirement age as long as you're going to be below that $56,520 for the period of the year that you're under full retirement age.
Okay, so we're talking about some numbers out there that people will be collecting, and before they get so excited of how much I'm going to have, Social Security benefits are taxed, correct?
They could be, yes.
They could be. So
yes.
How and when are Social Security benefits taxed?
So, what you have to do to determine if you're going to pay taxes, federal income taxes anyway, on your Social Security benefits is first you have to look at what we call your combined income. Your combined income is going to be comprised of your adjusted gross income, your non-taxable interest income, and then 1/2 of your Social Security benefit. So once you know that, you know your combined income, then you can look at, if we can advance to the next slide, you can look at a table that will show you whether or not you're going to have to pay federal income taxes. So if you think about what we just talked about with combined income, for federal tax liability, you have to look at your filing status, your tax filing status. So if you're an individual, you file individually. If your combined income is less than $25,000, you're not going to have to pay any federal income tax on your Social Security. If it's between 25, easy for me to say, 25 and 34,000, you're going to have to pay income tax on up to 50% of your benefits. And if it's more than 34,000, you're going to have to pay income tax on up to 85%. And then the thresholds are a little different, as you can see on screen. If you're married filing jointly, less than 32, it's 0. 32 to 44, taxable on up to 50%, and then more than 44, up to 85%. But the good news is, at least at the state level in Illinois, you don't have to pay state income taxes on Social Security. and there are several states that are the same way. So you would want to research that. If you're outside of Illinois, you'd want to research what it's like in your state.
Now, I'm assuming most of our viewers here will be from Illinois, but you oversee Illinois and Indiana. Do Indiana residents pay taxes, state taxes on Social Security?
So, that's a great question, and I work with a colleague in Indiana who would get more into that. To be honest, I don't know off the top of my head.
Okay.
But one thing I was going to mention about this, and there's a resource in the chat. If this is a surprise to you and you're not interested in paying at the end of the year when you file your taxes, there is a way that you can ask for us to withhold. There's a form W4V that you can use, and we will withhold federal income taxes from your monthly benefits if you're interested. It's voluntary, so everybody has their own preference on how they do that, but it is something that's on the table if you're interested.
Okay. Well, there's something to consider when people are looking at retirement and where they want to live in retirement. The fact that Illinois does not tax Social Security benefits is a reason to stay in our state.
Yes.
So we have a broad audience today, including those from the private sector as well as many state employees. Can you tell us how working for a government agency might affect benefits? I know there's a wide range between teachers, state employees, university employees. What can you tell those listeners who are government employees?
Absolutely. There is a chance that your pension from a governmental entity could have an impact on your Social Security benefit. What you have to look at there is whether or not you paid Social Security taxes on your earnings while you were working for that employer. If you're not sure of that, the best way to find that out is to go to your My Social Security. Exactly, yeah. SSA.gov. Go to that My Social Security account, look for the Social Security tax wages column, and you'll see if it's there, you paid it. If it's not, you didn't. But the reason that that's important is because if you qualify for a pension based on work that wasn't taxed by Social Security, that could potentially trigger one of two different things that could impact your benefits. There's something called the windfall elimination provision. There's also something called the government pension offset. Now, in the chat, we have links to resources on both of those types of things. Just to give you a real quick overview, the windfall elimination provision would impact the benefits that you get on your own Social Security record. So if you worked outside of your governmental employment and you paid into Social Security enough to have your 40 credits, there is a chance that that non-covered pension is going to impact the Social Security you've earned, and that windfall elimination provision is what would cause the impact. And then the government pension offset would affect benefits that you're potentially eligible for on a spouse or a deceased spouse's record.
Okay. We do have a limited amount of time today, so we can't get into all the nuances of Medicare. Can you tell us some of the basics people should be aware of?
Yeah, Medicare is probably a topic in and of itself. Sure. They have a great website, Medicare.gov, so you can learn a lot about Medicare there. But one thing I would like to talk a little bit about is just eligibility. How do people become eligible, and at what points do people become eligible? So there's age-based eligibility, which is probably the most common. And an important thing to point out there is Medicare eligibility age is 65. It didn't change with the full retirement change for Social Security. So if your full retirement age is 66 or it's 67, you're still eligible for Medicare at the age of 65. So that's something we want to make sure people are aware of. There are other ways that younger individuals can qualify, though. If you're on Social Security disability, once you've been on disability for 24 months, you become eligible for Medicare. If you have a diagnosis of ALS, you become eligible for Medicare as soon as you go on disability. If you have kidney failure that requires dialysis or transplant, you can go on Medicare even without having disability benefits. But the key takeaway is probably, that age-based is still 65. So don't get confused with Medicare age and full retirement age.
Okay. Now, I found this fascinating. You've answered lots of my questions, but the audience has chimed in with some questions, so let's go to some audience questions. First one, do all Social Security recipients receive an annual statement of benefits to be used with filing of income tax returns?
That is a great question. That is called an SSA 1099, and we do send those out in January of the calendar year. So if you receive benefits in 2023, you should expect to see your SSA 1099 in January of 2024. Starting February 1st of 2024, you'll be able to log into your My Social Security account.
All right, now, so my suggestion, SSA.gov, is there a backslash to get to yours, or do you go to SSA.gov and then click on My Social Security?
So either way would work. You go to ssa.gov/myaccount, or if you just go to ssa.gov, then you can look for My Account, My Social Security all over there. But once we get to February of each year, you can actually log in and print a replacement 1099 for tax purposes if you've misplaced it. You should get it in the mail either way, but if you've misplaced it, you'll be able to get a replacement online.
Well, I don't have to worry about that just yet, but I am going to check out SSA.gov today and check out my history. Another viewer asked, is the reduction in benefits due to working while receiving benefits on top of the reduction that is already calculated for receiving benefits prior to full retirement age?
That's a great question, and the answer is that yes, it would be. So the reduction that you see for taking your benefits early is, basically determines what your monthly benefit amount is going to be. And then from there, we would look at any kind of additional reductions that would be in play because of excess earnings. So if you were under your full retirement age and you exceeded that earnings limit and you had to pay some money back to Social Security, that would be after the reduction that's age-based was computed. Now, one thing that I will point out, because this is a great question and it kind of gets to this a little bit, the reduction that you see for taking your benefits early is a permanent reduction. About the only exception to the permanency of that reduction is when you get to your full retirement age, we're going to look back and we're going to say, okay, this individual drew their benefits 48 months early. Okay, and so we applied a 48-month reduction factor and paid them accordingly. Mm-hmm. But over the course of those 48 months, they ended up having to pay some money back to us because they worked and made too much. So we will adjust from full retirement age forward, we will adjust that reduction factor to remove any months that you had to pay back. So there is an adjustment that happens automatically, and you don't get permanently reduced for months you didn't end up getting payments.
Okay. Another viewer asked, can someone retire at 65 but wait to claim Social Security retirement benefits until age 70? So I'm assuming someone has earned enough, has good savings, doesn't want to work anymore, but says, I don't need the money right now. Can they hold off to claim until 70?
Absolutely. The delayed retirement credits are payable because you didn't start to collect your Social Security retirement benefits. There is no requirement that you continue working to earn those delayed retirement credits. So you could retire and wait, and then later on, when you start to draw, you would get those delayed retirement credits.
Okay. I think I know the answer to this next question, and I think they might not like the answer. If someone elects to take Social Security benefits early, the monthly amount is less. When they reach full retirement age, do their benefits increase?
We get that one a lot, and
sure.
Unfortunately, no, the benefit would not increase. So that kind of speaks to the permanency of that reduction. Exactly. So it wouldn't go back up. You are taking a permanent reduction for taking it early.
Okay. If one spouse was on disability due to health issues and then passed away, would the other spouse who is currently working be able to receive survivor benefits at age 63? Would their benefits be reduced?
So if the spouse who's age 63 is still working, they would be potentially eligible for survivor benefits, but remember, there's that earnings limit. They're under full retirement age, so they would be subject to that $21,240 earnings limit, and that goes up a little bit typically from one year to the next, but that's the limit this year. So we would have to look at that first. Depending on where their earnings fall, they may not be eligible to draw that survivor benefit yet. But whenever they do retire, they would be eligible to collect a survivor benefit off of the deceased spouse. And that would get into that whole claiming strategy where they would have to weigh out what made the most sense. You know, for them, in that scenario, it might make sense for them to start drawing as a survivor upon their own retirement and then switch to their own retirement benefits later at age 70 if the numbers were favorable in that way.
So if someone has to deal with all these variables and is uncertain, can they go into Social Security office and have someone help them work through what is the most advantageous to them?
You can. You know, that's most of our applications retirement benefits, spousal benefits, Medicare, we recommend that you do them on our website, ssa.gov. You can apply for disability that way. One of the things that we don't yet have on there is the survivor claim. So if you're wanting to apply for survivor benefits, you do that through us, either by phone or you can come into an office and talk with someone about it. And part of that is because we want to talk through some of these claiming strategies and options with you, just so you know what your options are.
Okay. So we're getting near the end of our time, but we have lots of viewers, we have lots of questions. I'll try and go a little faster. What if an ex-spouse remarried and divorced again? So I'm assuming someone was married twice, divorced twice. Whose benefits do they collect from?
So in order to qualify as an ex, remember, you have to have been married for at least 10 years. So in order for them to have options of which ex-spouse they draw off of, they would have to have been married to both for at least 10.
So if someone was married, had 2 marriages of more than 10 years, how then do they determine who they collect from?
It would be the highest one.
Okay. So FICA is taken in my paychecks. Is that my contribution to Social Security?
It is, yes.
Okay. Is Medicare premium deducted from Social Security?
If you are collecting a benefit from Social Security, your Medicare Part B premium will automatically be deducted from your monthly payments. Medicare prescription drug premiums, when you sign up, if you sign up for that, you can choose if you want to have those deducted from your monthly payments or if you want to pay the company directly.
Okay, I think we've got one more question. If I receive Medicare at age 65, what happens to my free state health insurance as a retired state employee? I know we have a lot of state employees and retirees joining us today.
Yes, so I have to be a little careful here when I start to speak to state benefits, okay? So I want to offer that caveat that I am not an expert on state benefits, but my understanding is that if you are eligible for free Medicare Part A because you've worked enough, you've paid in enough, that when you become, if you're retired, when you become eligible for that free Part A, you take the Medicare Part B and your state retiree coverage serves as the secondary to Medicare. Because a lot of people will purchase a secondary policy to help supplement what Medicare doesn't cover. And I believe that's the role that your free state insurance plays at that point in time.
Okay. Well, we've covered a lot of detailed information today. If you had to choose one action item for our audience to do when they leave, what would that be?
Without a doubt, it's create that My Social Security account. Go to ssa.gov/myaccount, set up that account. It is a fantastic financial planning tool.
Wonderful. Well, unfortunately, that's all the time we have for questions today. Jack, thank you for joining us. We hope this conversation encourages you to start or continue planning for the future. The FinWell Hub is a great resource and has a retirement analyzer that can help you assess whether you're on track for retirement or need to make some adjustments to reach your goals. As always, the link is in the chat. The recording for our goal setting and budgeting webinar is now available on the FinWell Hub. You can watch it on demand and share with your friends. Before you leave, please take a minute to complete a short survey to provide feedback about today's webinar and suggest topics for future programs. We're listening to you. We want to provide something that's of interest to you. So thank you all very much for joining us today. Thank you to Jack for speaking with us and sharing your expertise. We hope you heard some useful tips today and will share them with friends. Have a great day.